love taxes? Gary, why do you love taxes? Yeah, just different. All right. So taxes, again, big part of financial planning, right? It's your biggest expense in life. So you really got to pay attention to it and make sure we're taking advantage of everything that's out there. So in 2026, again, we use kind of the same kind of base presentation on this, because some of this stuff doesn't change. The numbers change, and we'll go through a lot of that, but then we have some updates of things that actually did change. So we'll hit on some things that are new. But taxes, again, so 2026 going forward, and what we're going to look forward to. All right, obviously disclosures here. We're not CPAs, we're not tax attorneys, we're certified financial planners, so that's that part. Topics we're going to look at, again, in general, just going to be a minute. Most of our stuff that we do is educational, so we're going to go over that again on how taxes are calculated, right? The deadlines, the adjustments, how the tax brackets and the standard deductions work together. What's the difference between income on your tax return versus capital gains and qualified dividends? Contribution limits to retirement accounts. Secure Act 2.0 updates, so that's some of the things we'll look at. Gift and estate tax, a lot of questions about that. And then just some of the major changes that we got coming out. All right, so again, kind of just start off on a definition, right? So calculating your taxes, there's a gross income amount, right? So if you're working at a job, you have a salary through a W-2 or a 1099, or you're retired and you're getting income from Social Security or distributions from your retirement accounts, these are all numbers that go into your gross income. Any bonuses, investment income that are short-term, we'll define that in a little bit, short-term versus long-term gains. If you're lucky enough to be one of those people that have a pension, right, that's going to be income that counts as gross income. And then any retirement distributions from your accounts. So then you start going through your deductions. All right, what are some things that we can have deductions for? So again, it varies depending on how you file. Obviously married or single is the ways most everybody does. Itemized deductions, this is how we can start lowering that income amount, right? And we try to really get to your effective tax rate, right? So your marginal rate is kind of where your last dollar income falls, and your effective rate actually is where your income is after all your deductions to it, right? So here's some of different things you can include: state and local taxes, medical expenses, charitable distributions, mortgage interest, professional expenses. Again, those are itemized deductions. A lot of people now don't really itemize anymore because the standard deduction is so high, right? And we'll again have an explanation of that, how that is calculated. On this itemized deductions, a lot of people are some people track all these healthcare expenses. What's my mileage when I go to these doctor's offices? So a lot of people, when these standard deduction is so high, thank goodness I don't have to keep up with that anymore, right? Let me just take the standard deduction and move on. So that does save some time on that front. Adjustments on your taxes, again, if these apply to you, you can kind of see how that looks on your adjustments as far as your income. Your retirement plan contributions, again, if you're still working, different things that we can talk about there. Tax credits, those are going to be what everybody's really after, because that's the most kind of bang for your buck on your tax return, is if you can do any of these tax credits. The big one here obviously is going to be probably child and dependent care, and we have an example of that here in a little bit. But again, if all your kids have grown and moved out, then oh well, right? You lose that part of it, but I still think your overall expenses probably go down when a kid leaves the household, right? Gets off the payroll, so to speak. Deadlines, again, just a lot of various deadlines you can see here. Big part of the kind of time we're in now, people are asking about, when your 1099s are generated. So technically, they don't have to be sent out till January 31st. So a lot of people from Fidelity accounts and other companies, banks, and all that stuff, they don't have until January 31st to start sending that out. So we always say, again, probably the first, second week of February, you're going to start getting your documents, right? Well, then don't be too quick to rush and do your taxes, because sometimes they have, amended or corrected 1099s. So again, when that happens, it can be frustrating if you've already filed your taxes, and some people say if they get mad at us or Fidelity, but it's not. So how that really works is that the custodian that we work with, again, is Fidelity. Fidelity gets all their information from the fund companies. Well, the fund companies mess something up, and they have to reissue a new 1099 and send it out. So what if you already filed your taxes and there's a corrected 1099 that comes out? then you have to redo your taxes again, right? So it happens sometimes. So I mean, a lot of times we'll tell people maybe wait till even March to potentially do taxes, just to make sure everything's in, right? Like right now, I got my file started of this is tax information, and just throwing it in a file until I think I have it all, right? But again, April 15th, obviously the big one, tax day. That's a big key what we're looking at. Here's your brackets. So again, this is how your tax rate is calculated, right? So as you can see, if you're single or married filing jointly, you can see how those are structured. So again, we start at 10%, and then it goes down all the way up to the highest bracket currently is 37%, right? You've got the income gate ranges on that front. So the biggest jump in the tax code, right, is that 12 to 22. Imagine that, right? That's probably where most Americans are. So that's a big jump in the tax code on that front. It's a progressive tax system. So a lot of people, this is another big misconception people have. If somebody says, well, if I'm married filing jointly and I'm in the 24 bracket because I make $211,000, then everything is taxed at 24%. But that's not true, right? That's where your last dollar falls. That's where we call that a marginal rate, because you have some that's tax-free at your standard deduction, some taxed at 10, another chunk at 12, and then only a little bit taxed at, or some at 22, and then some a little bit at 24 to wherever you fall, right? So then you get your kind of blended average, right? So if you say I'm a 24% marginal, technically, if you want to look at it roughly, take 6 percentage points off of that or so, and you're really effectively only paying 18% even though you're falling into 24, right? Does that make sense? The difference between marginal and effective? Okay. So that's a big question we get a lot. But again, progressive tax rate, that's a positive thing. What this shows, we always have this up every year, because again, nobody likes paying taxes, but this is kind of hopefully a slide to make you feel a little better, right? So this talks about the historical tax rates. And if you look at it, from 1960, the highest rate was 87%, the lowest was 26. And then today, the highest is 37, the lowest is 10, right? So I mean, that's a massive break, right? So we look at that, and you know, obviously people tend to say, well, history tends to repeat itself, so are we ever going to get back to those 1960 tax rates? Who knows, right? That's what we call legislative risk, whatever Congress decides to do, right? So it wouldn't be a very good day for those politicians if they did something like that, but I don't think they get reelected, and they know that, so who knows what's going to happen from that front. But this is another reason to kind of show you what happened in these changes. So again, with the Secure Act being passed, this really grandfathered in these tax rates. So again, if you've come to these classes in the past, we've always talked that if something doesn't get passed at the end of 2025, January 1, 2026, these rates would revert back to 2017 rates. And that's why we have that column there. So if Congress didn't act and take action, these January 1, all the brackets would go up, right? 10 would stay the same, the 12 to the 15, and you can just see the difference, right? So the fact that that big beautiful bill that got passed, right, it would locked in these rates, make sure they're lower, and that was a huge win, right? They're permanent, quote unquote, permanent, right? Nothing's permanent when it comes to Congress, but at least they don't have a sunset or an expiration date, right? So, but how can they change again? Somebody else gets elected, and they get enough votes to change it, right? But right now, at least they don't really expire, and so we can feel pretty good until the end of this current president's term. This is where it's going to be, okay? So that's a good thing, and it also drives potentially Roth conversion strategies to do, and again, we'll have some examples about that. But again, hopefully, they never go back to those 1960 rates, because that wouldn't be fun. So historically, we're in pretty good shape when it comes to tax rates. Nobody likes paying them, but at their historical low levels, and then you compare that to what the rest of the world is paying, we're sitting pretty good, honestly, when it comes to how much we're paying taxes and what we get and the freedoms that we get. That's the way I look at it. It's my patriotic stand, I guess. All right. Capital gains, all right, so we'll talk about that. So this is the sale of an asset. So investments in real estate, obviously, are the big ones that most people get impacted by. So this is non-IRA accounts, right? So if this is money you just saved and invested, they're not in the retirement plan, then they can have capital gains treatment. You got short-term versus long-term. Well, also you see this in real estate, right? So if you live in a house and again, you kind of see this like grandma was living in a house, she paid 50 grand for it 50 years ago, and now it's worth $300,000, right? Well, there's a capital gain in that, right? So if she sold it while she was alive, again, primary residence, she has some extra tax benefit there. But let's just say it was not her primary residence. Let's just say it was another piece of land that she owned. She paid 50 and it's worth 300, right? She held it for at least more than a year. She'd get long-term capital gains treatment, and she'd have to pay taxes on $250,000 worth of gain. Okay. So that's going to be the long-term capital gains rate, and we'll look at those rates here in a second. If she held it less than a year, then it's short-term, which is really wherever your income is on your tax bracket. So this is what a lot of people want to hold it at least an investment for 1 year, 1 day, if it makes a difference, and they can get more favorable tax treatment and get it taxed at long-term capital gains rates, right? But investments have the same thing. I bought Apple stock 20 years ago. At this price, it's worth this. You know, if I sell it, I can do it as long-term capital gains treatment instead of my income. Dividends, so again, distributions of earnings, shareholders with assets. So there's funds that we use out there that pay dividends. There's stocks that pay dividends. There can be some more advantageous tax rates on the dividend taxes. You got qualified versus non-qualified. So again, you can see that, you know, running this too often, but there are some individual stocks that pay different dividends and they can be taxed at different rates. So here's our example of the long-term capital gain rate. So this is what I was mentioning. So remember, a lot of people, honestly, if your income's kind of in that mid range, in that 12-22% bracket, there's not a massive, like so let's say you're in a 12% bracket. It's not a huge difference between long-term capital gains and your regular capital gains, right? Because 12 and 15, you know, are about the same. So again, if you can look at our ranges, so single, 0 to say 50,000, married, filing jointly to 98,000. So again, if your income is in that range and you have some appreciated stock, you want to sell it, and you've held it longer than a year, 1 day, then you could get long-term capital gains treatment and pay 0% tax on. That's a pretty beautiful thing, right? Next tranche below it, it could be at 15%, and then the highest it can get is 20%. So if you think of someone who may be in the 37% tax bracket as their income, they don't want to pay income, they don't want to pay taxes on 37%, they'd rather get long-term capital gains treatment so they can only pay 20, right? So that is a pretty big benefit to higher income earners to say, hey, I'd rather have long-term capital gains treatment. Okay, again, that's on investments, that's on real estate, it's on business sale, so it can be that across the board. Again, this is only federal taxes, okay? So you've always got to factor in the state as well on top of that. They're going to get the pause in it too. So retirement plan limits. So we got the limits that we can put contributions in, but this is talking about phase outs for Roths. So Roth IRAs are beautiful things. This is if you make a if you're working and you have earned income. We get this question a lot too. You have to have earned income to put money in a Roth. All right? You don't have to have. That doesn't really matter if you're doing Roth conversions. That's different. Okay? But you have to have earned income to put money in a Roth. And you can see based on how you file. Again, just use married filing jointly on there as an example because it's bold. If you make under 242, as a household, make under 242,000, and then you can, if you're married filing jointly under 242, then you can make a full contribution to a Roth account. Again, you got to have earned income. That's earned from a job, a W-2, or a 1099 if you're a contractor. All right. If you go over that between 242 and 252, then you can only make a partial. And if you're over 252, you cannot make a contribution at all to a Roth. Okay? So that's if you have Roth 401k, another set of rules. So again, Roths can be confusing because you have a contributory Roth, a Roth 401k, or a conversion Roth, right? And there's different rules for all three, depending on how it applies to you. So that's stuff that we gotta keep in mind, obviously, when we're looking at that. So the high income earners, they cannot put money in a Roth on their own, but they can put money in a Roth 401k because there's no income limits to that. Another box down below talks about deductibility of IRA contributions. That's another set of rules. Some people, again, if you make too much money, you put money in a traditional IRA outside of a workplace plan. If you're over a certain income, you can't get a deduction for it. Right? So again, just things to be thinking about. Sometimes gets people if they're in those income ranges.
Brandon, is this gross?
Yeah, it'll be gross income on, let's see. Yeah, because they're gonna do your modified adjusted gross income, I believe, which adds in all your other IRA contributions and everything, the 401k deduction. So you gotta look at what number, right? When you're looking at that number, you got, like I said, gross income, adjusted gross income, modified adjusted gross income, provisional income for Social Security. So again, depending on what you're talking about, this depends on where you're at, right, on what you can do. But again, if it's inside of a 401k, you don't have to have these income limitations, right? So this is something else that's always been big in Congress. So this talks about your max earnings that is susceptible to Social Security payroll, Social Security taxes coming out, right? So if you see the different years, 24, 25, now we're at 26. So this is an example. If somebody makes over 100, say somebody makes $500,000 a year, right? Well, only Social Security Medicare taxes are taken out of the first 184. So throughout the year, if they get in like August or mid or whatever it is, midway through the year, and they've already got paid $184,500, or the paycheck's automatically going to go up because they've maxed out what they can put into the system, so therefore they don't pay taxes anymore, Medicare and Social Security taxes on that income, and it just comes straight to them to their bank account. Right? So you might see some people like, what happened? My paycheck went up. How did that happen? Well, that's because you went over this limit, right? So that's a big thing that is probably on the table that we're assuming will change as far as Social Security changes. Because again, right now, 2030 to 2031, Social Security is going to run into some issues, and the next president is going to have to deal with it. Again, no president wants to deal with fixing Social Security because you're going to make a lot of people mad. No way around it, right? So, but normally what they do is they grandfather the people in that are currently on it or close to taking it, and they won't change what you're set up, because again, most people in this room, if you're on Social Security, you're usually not impacted because you rely on that income. So they usually grandfather you in and they change it for people, say 55 and younger, okay? One of the bunch of ways to do it, one of the easiest ways is to increase this income, right? Say, hey, if you make high income, that's great, but let's take 184.5 to maybe 400,000. Right, and say that's how much Social Security and Medicare will get off of those wages of current workers. Right, the system only works if you've got current workers, right? So that is something that we'll probably see change, I'm guessing. We'll have to wait and see how they change it. Again, it's not going to be probably until the next president that's going to have to fix it. Secure Act 2.0. So these are some other changes, again, for people that are still working. Required Roth treatment for high income catch-up contributions. So if starting January 1, if you earned an income over the threshold of the 150, adjusted for inflation, all your catch-up contributions to a workplace plan, again like a 401k, 457, 403b, you can do catch-up contributions. So once you hit your max, you can do catch-ups, but your catch-ups then have to go to the Roth side if you're a high income earner. So this is a big change for the plan space and the 401k side plan space, because they're going to have to change the plans, and the custodians are going to have to figure out where, oh, you've maxed it out, now your catch-up contribution has to be moved to a Roth. So that's a change. Why did that happen? Well, when you put money in a Roth, you pay your tax now. So I think it's a way for the government to raise more tax revenue, because you're not deferring it for later, right? If you do a pre-tax contribution or a traditional contribution, it lowers your income tax that year, stays tax deferred, you pull it out in retirement, you pay taxes on it. At what you put in plus what accrued. Right, on the Roth, as you put it in, you pay your taxes as you put it in, right? So think of how much money is sitting out there in IRA plans that haven't been taxed. The government's just like, you're drooling over right now to try to get to, right? So again, so this will cause more income to be taxed. So that's really what it comes down to.
Your interest on your lots, that, you pay that every year,
The interest. So
taxes on the interest.
yeah, so I'll explain it. So when you put money in a Roth, think about it, it's already been taxed, right? The beautiful thing about a Roth, and we'll talk about that too here in a second, is that any money that you make off of that money now is tax-free, and you pull out retirement tax-free. So think about this. Again, life is all about how to pay the legal amount to the government, but and then keep the rest in your pocket, right? So again, if we're in historical low tax rates, depending on where your income is and where your lifestyle is, it might make sense to do a Roth right now, right? Because if we're at historical low rates, don't you want to pay your tax now instead of deferring it later to who knows what it's going to be? And who thinks tax rates are going to go down in the future? Raise your hand. Who thinks they're going to go up? Right? I mean, yeah. So I mean, that's the idea, right? So just pay your taxes now, potentially. Again, depends on your income situation and what your lifestyle is, but it might be advantageous to do that, right? But once that money's in a Roth, like I said, I have a slide I think that talks about some of that stuff. So again, this is more so, again, current plan business. So estate tax. So if individuals who die in 2026, the lifetime estate and gift tax exemption is $15 million per person. Okay, that has increased because last year it was 13.99. Right, so a lot of people are concerned about estate taxes. Why are they concerned about estate taxes, right? Well, because of one thing, it's a big scary thing, right? Nobody wants to pay estate taxes, but not a lot of people have this problem. Why? Because you have to have each person, so if you're a couple, you have a $30 million exclusion, basically, lifetime amount that you don't pay estate taxes on. So come see me if you got over $30 million after, and we don't work with us currently, okay? So that's not usually an issue. So the $15 million exclusion is there, and that's a huge limit. Yeah? In the past, in the 70s, 80s, or whatnot, 60s, 70s, this exclusion used to be super low, $250,000, $300,000, $400,000. Well, that was an issue. What happened then? A lot of people were doing trust work and trying to shelter things, right? Well, now it's really not that big of an issue because the exemption is so high, right? So if you do have this problem, even Warren Buffett said, if you pay estate taxes, you did poor planning. So there's a way to minimize this in the long term. You just got to do the proper planning, right? Another big thing about this is the annual gift tax exclusion remains at $19,000. That's another question we get a lot. It's like, hey, that's great if my kids, get this money when I die, but they kind of need it now, right? Not when I die. I would like to see them enjoy it, right? What can I do and how can I give them money, right? And people are concerned about going over this $19,000. But again, as an example, let's talk about that. Mom has $19,000 she can give son, dad has $19,000 they can give son, right? And not have to file a gift tax return. And then if mom wants to give son, the daughter-in-law, 19, and then dad can give daughter-in-law 19. So you can get some pretty big chunks of money to them without having to avoid this, right? But at the end of the day, if you want to give more than that, that's not an issue either. What do? You got to file a gift tax return. All right, that's not that big of a deal. You might have to pay a little extra to your CPA to file a form, but at the end of the day, there's a form they file, and what it does is it eats into your $15 million a person. So if you give away, you want to give them $200,000, that's fine. They're just going to deduct it off your $15 million per person. Okay, so that's not really that big of an issue. No, you don't get a tax deduction if you give your kid money. We get that question a lot. The government doesn't care if you give them money. And then it doesn't hurt you, or it doesn't hurt or help you. It doesn't hurt or help, well, I guess it helps them because they get money, the kids. But it doesn't hurt them as far as their taxes either. So that's a big clarification we go over a lot with clients. All right, gift tax. So again, tax advantage strategies that may allow you to pass wealth on to the next generation. So again, annual gifting to them to reach those limits. Again, if you go over it, it's not that big of a deal. to give money out to next generation Roth IRA beneficiaries and TOD designation. So TOD, these are putting beneficiaries on non-IRA accounts. All right, brokerage in the brokerage advisory world is called transfer on death, TOD. So some people might have a joint account with a TOD on it. That just means it has a beneficiary on it. So therefore, if both owners pass away at the same time, then it goes to whoever you name. Okay? Big thing about this too is beneficiaries, you can have beneficials in every single account you have. Bank account, they call them more payable on death or POD, right? But you can put beneficiaries on your bank accounts at the bank, put beneficiaries on your investment accounts and your retirement accounts. All right, the reason you do that is that those funds flow directly to the people you want them to go to outside of probate, right? They don't have to worry about going through the estate process and deal with all that, right? So it's a clean way to give it straight to your beneficiaries, okay? They can be people or they can be charities. Life insurance obviously is a massive way. Whenever we hear somebody that says, I really want to make sure the kids have X dollars at the end no matter what. Well, that's the best way to do that is to do life insurance, right? Because who likes money that's tax-free? Everybody does, especially the people who are getting it, right? So tax-free is a beautiful thing. Life insurance is one of those investments that you can start spending down some IRA assets to turn it into a tax-free death benefit at your passing. That's going to be the most efficient way to give the next generation money, right? Because all you're doing is using leverage, all right? But what do you got to do to get life insurance? Well, you got to be insurable, right? Can't be super, super old or it's really expensive. So you got to look at your health and age. And if you're a tobacco user, that really hurts a lot too, but still potentially possible. But those are the things that they look at to get approved for life insurance. So again, as far as passing tax advantage to the next generation, that's a beautiful thing. While you're still alive, if you want to save some taxes, you got DAF accounts or donor advised funds. This is a situation where somebody, maybe they get a settlement or they sell their business or something like that. They can dump a chunk of money in a donor advised fund. So let's say somebody sells their business for $3 million and they get it in that tax year, they get $3 million and they're like, man, I have to pay a lot of taxes on this. What's something I can do to offset that if I'm charitably inclined? They can open up a donor advised fund, drop $100,000, $200,000 in there, whatever it wants, and it offset their tax liability that year. Then that money can stay invested, it can grow, and whenever they want to give money to charities, they can just make a request in the charitable account. We work with Fidelity Charitable to do accounts like these, and it goes directly to these charities, and there's no taxes due on it because it's going to a charity, right? So that's a pretty cool way to use a donor advised fund. Donate appreciated assets. Again, you want to make a contribution. We work with some nonprofits that people do this. Hey, towards the end of the year, stock market had a good year. I have a low cost basis, like I paid $5 for the stock, now it's worth $100. Let's donate that $100 to the charity so I don't have to pay taxes on the gain, right? It's better to pay those charities appreciated assets than paying out of your checking account. It just helps you on your taxes. So that's what that means, donated appreciated assets. QCDs, qualified charitable distributions, another great strategy to use. Don't give money to charities if you're over 70.5 out of your bank account. Give it from your IRA, right? RMD age, again, it's going to depend on your age, but we have it at, you can start this at 70.5, right? So you don't have to be RMD age to do it. If you give to a charity, a church, whatever, give it from your IRA, as long as it goes directly from your IRA to the charity, no taxes are due. Right? So that's nice as well. Otherwise, if you give it from your checking account, that's income that you got coming in that's potentially taxable. So give it from your IRA to avoid those taxes. Again, perfectly legal way to do it. All right? So that's a lot of people get to use that, so that's nice. This is another big one. So we've talked about base law stuff. We really talked about is federal. So this is for North Carolina. So again, there's some states, every state has their own different way of doing taxes, right? Some are zero, right? Zero state tax, right? I think there's like 8 or 9 different states in the country that don't charge state taxes. Florida, Tennessee, South Dakota, some others out there, of course, that don't charge state taxes. They're trying to lure people in that are retirees to say, hey, come live here because we won't charge you state taxes when you take money out of your account. All right? North Carolina, we have an income tax rate, it's 3.99. It was 4.25 and it dropped to 3.99. So that's pretty good, right? Don't really see that going that way. How many prices usually are going up, right? Not down. So this is actually a big deal that happened this year. Corporate tax rate obviously got adjusted downward as well. Child tax credit, again, this is a new thing. For people that have children, they can do actual credits. Remember, credits are better, more bang for your buck, the dollar-to-dollar reduction in taxes. So again, this is just an example. If there's children, there's phase outs, there's income limitations. But again, $2,200 per qualifying child under the age 17. And so we have some examples here based on where your income's at, if that's something that benefits you. Middle class worker deduction, so another new thing that's happened. Again, you've kind of heard about some of this stuff, overtime deductions, tips deductions, so auto loan interest deductions, so that's a big one. I guess the car dealerships like that one and the manufacturers, right? So there's some benefit to that potentially. Again, all this is going to be based on, again, when people run on the platform of saying, hey, no taxes on Social Security, no taxes on tips or wages. Again, there's always going to be guardrails on that, okay? So it's going to benefit people that they're trying to benefit, which is going to be, again, hourly workers, service workers, skilled trades, things of that nature. If they're making lots of money, it's not going to help them, okay? But again, this was a big deal. It's going to help a lot of people. Again, a lot of people this all got passed, so as they're doing their taxes, all these deductions are going to be automatically taken into effect, and you see how the outcome of their taxes are going to be. Retirement contribution savers credits, again, there's another one. These are the maximum contribution limits on 401ks. There's your catch-up if you're over age 50, IRA, HSA. So these are going to be the 2026 figures. Again, they all stay about the same, and every now and then they go up, $500 or so every few years, and continue to go up. Savers credit, again, there's another credit here for saving extra. You can see the guardrails are on it based on your income. And there's an example down there of how they could calculate it. But again, an extra benefit for savers credit. SALT deduction, again, not a huge deal here, right? But this is some places that have massive state income tax, property tax, and local taxes. Probably the local ones are the ones that really get it. So these are the people living in the big cities, basically. There used to be a cap of $10,000, you can see in the little box there, and now it's up further. So again, benefits homeowners, high property tax states so that have high tax. Again, luckily we're in North Carolina. We're pretty tax advantageous state, right? Prices aren't through the roofs, even though people move here all the time, right? But they're not really as crazy and high as these big cities. So we're in pretty good shape in North Carolina. I was kind of, spoiled by growing up here and living here my whole life, and then you see home prices and cost of living things around here, and then I was like, oh, well, let's move out, go somewhere else, and you travel to different places, and it seems like every place I went, they're more expensive than here. So when it comes to taxes and everything, so that kind of factor in your decision. So we're in a pretty good shape when it comes to taxes. Stack deduction. Okay, this is where we get into probably that has the most impact of a lot of people in this room. So this is stack deduction. So this is where we're going to talk about this concept of no taxes on Social Security. So that's not the case at all. Social Security taxes have not changed, right? It's not changing. They are where they are, right? What has changed is that if you meet certain criteria, you can have extra deduction on your taxes. So when you look at that, I think we have an example, a couple of different examples here. So let's look at this one here. Example 1, single retiree, age 67, income $70,000 a year. So they get the base standard deduction, which is $16,100. So again, that's the standard deduction that all single people get. That's the first $16,100 in incomes, tax-free. Then you have a new senior deduction of $2,050, that's the senior deduction of $2,050. That's not changed. That's if you're over 65. Then new senior bonus, that's the new one. That's the $6,000. So this is where the current administration with the bill, big beautiful bill is passed that says this is how we're gonna offset, indirectly offset your Social Security taxes, is if you're a certain age and under a certain income. And that senior bonus is $6,000 per person, right? So you can see that in this situation, where that's at, the new standard total deduction is $24,150, and that's how much that first $24,150 is not taxable. Okay, so again, it can, if you're in an income situation where your Social Security is taxed, it's still getting taxed, but there's this extra deduction that's sliding in here to try to offset those taxes. Okay, that's the huge difference. It gets explained in a million different ways, usually incorrectly every time I hear it on TV, but that's really how it works. Okay, so there's no changes on Social Security taxes, but you could have an extra deduction to theoretically offset those taxes. Okay, does that make sense? I'm sure people have heard different things about that, so hopefully that was a thing of clarity here. We got more examples. Here's married filing jointly, so both spouses are 65 plus, income at 120. So the base standard deduction, there you go, 32,200. That's normal. They're both over 65, so then they get each 1,650 times 2, so you get another 3,300. And then the new senior bonus deduction, 6,000 times 2 people is 12 grand. So in this scenario, this total standard deduction is 47,500. So again, these are going to be pretty massive when people do their taxes. So this is for 25. So people doing your tax, you'll see it benefit in 25, 26, 27, 28. So it'll be towards the end of this administration, right? When the new president comes in, it expires. It's gone. Okay. So pretty good opportunity to shield some taxes and be able to pay less, right? So another example that we have, the top limit of this $6,000 extra one per person is $150,000. Once you go over $150,000, it starts paring down. It doesn't get cut completely off. They'll just reduce it pro rata basically on how much you went over. It's a calculation done from that end. So if you're 150 under, you get full credit for it, $6,000 per person. So advantages of Roth conversions, again, during this time, tax rates again are historically low. We've got this extra senior deduction for the people that qualify for it, right? The standard deduction went up, the senior deduction went up. So there's a lot of planning opportunities from there that could potentially let you convert more to a Roth, right? Again, this whole theory behind Roth conversions is somebody's paying that tax. It's either you or the people who get the money. So think about this too. If you pass away and kids get the money, a lot of times they're probably at their higher income brackets, right? Because hopefully they're a little older when mom and dad pass away. And that usually means they're either retired or they're at a higher income bracket. So if we want to give the government the least amount as legally possible, all right, and maybe give more to family instead of the government, of your hard-earned dollars, look at Roth conversions, right? Because a lot of times you can use mom and dad's tax bracket or lower than the kid's tax bracket. So when they take it out, they're going to pay more in income. Let's use mom and dad's tax bracket to pay the taxes and move on and make it tax-free going forward. Okay, so again, first line there is Roth contributions or distributions, they don't add to your gross income, it's tax-free. We use Roths for people that want to do Affordable Care Act or Obamacare planning, right? Health insurance. Those are massive. If you take money from a Roth, it doesn't count as income. It can get you a bigger subsidy for health insurance if you're under 65, right? So there's a lot of positives to the Roth side. You can't undo a Roth conversion. There's no required minimum distribution. So again, RMDs are non-existent with Roths. Why? Because you've already paid your tax on it. So you don't have to worry about that coming up. Again, and then you can leave it to the Roth to your heirs. Again, trust me, the kids definitely going to want Roth money or tax-free money than your taxable money, right? Again, there's fewer tax growth benefits to your Roth IRA earnings. So over time, again, if you do Roth, it's going to increase your taxable income that year. So you got to be careful. You got to look at the tax rates and where your income's at. The last one down at the bottom's a big one we got to watch out for. Is if you convert too much in a Roth, then you can go up in the tax bracket. You want to avoid that. Or it could also make your Part B premiums go up. And we'll talk about that. It's called IRMA, right? Nobody likes Irma, she's terrible. All right, Roth conversions of 12%. Here's an example of that. So again, it's base taxable bracket, $100,000 income. They take the standard deduction, they take the age 65 deduction, and then they take the income-based deduction. So again, a lot of things are going against that income. You add all that together, you kind of look at, hey, your max gross income is $148,300. So what that means in this situation, a couple, married, filing jointly couple, can make up to $148,300 and still stay in the 12% bracket. So that's pretty massive. Again, different for everybody, but we can look at it. Here's an example for the 22. Just another example. Like I say, the top of the 22 in this scenario, the married filing jointly, like 211 in income, 258. So again, do the difference there. That's how much they can convert. But then again, my next question is like, I mean, the next level is just 2% more. You know, it's pretty good too if you're not coming out of the 22 bracket. So again, I know there's a lot of math, a lot of numbers up on the screen, but it works, and we just got to run you through it and see if it's advantageous for you. So what changed for 2026? So again, middle income, working, retired, raising a family, it's more favorable. I mean, that's just facts, right? Big wins, obviously, you got larger standard deductions, bigger breaks if you're over 65, based on income, new deductions, larger tax credits for children, higher limits, of course, but that's pretty standard. That happens most every year. So again, everybody should be in a pretty dang good tax situation for the next couple years at least. Unless something major comes up, obviously, and have a huge taxable event. That's just got to work through it. But things are staying about the same. You should theoretically have more in your pocket. So really good planning opportunities for the next couple years. There's always planning opportunities depending on what you have going on and what you want to accomplish. So, but this year's got this is pretty strong. Any questions on that stuff or anything? Anytime an IRA, the first thing there is the same, I guess, across the board is you got to pay taxes to get it out, right? If you're under 59.5, there's a penalty to get it out. If you're over 59.5 and the money's in an annuity contract, that's a whole other layer, right? There are rules. Annuities are great. We use them in many different ways, usually as safety as bond alternatives, but for some people you can use them as income and other things. But when the downside to an annuity is you have a contract with this insurance company and you have to follow the rules. So therefore, if you usually take out 10% of what you put into an annuity without penalty. But if he comes in and says, hey, I want to take out more than that, then there could be a penalty, and that could be a reason he was discouraged in taking it out. Again, it depends on the investment vehicles. Remember, think about IRA, Roth IRA. Again, a lot of people ask us, well, how much does your IRA pay or your Roth pay? I mean, it's not a CD, it's not like that, right? These are just IRS labels, right? Pre-IRA just means pre-tax. It hasn't been taxed. Roth, it has been taxed. Everything's tax-free. Now, what we invest those in can be hundreds of different things. You can do stocks, mutual funds, bonds, ETFs, annuities. So again, that's the investment vehicle, right? So think of it up top as your IRS label for tax purposes, and then what it goes in those things, right? And depending on what they put, what he has his money in, it could be negative. I don't know. You have to look at it. Hey, I don't work with him, I don't think. So if you want to refer him my way, if you think that's a good idea. Some people are like, oh, don't worry, you don't want him, you know. I'm like, okay, I'll lean on you for that. But yeah, but I can. If you want me to look at it, I'm fine looking at it. If you need me to. Roth IRA 7,500. If you're under 50, if you're over it, it goes up to 80.
But you can convert whatever you want to.
Correct, yeah, the conversion rules are totally different. Yeah, you can convert whatever you want. That's what you convert to what makes the most sense in your income. Well, that is like a whole other class that I don't even know who to give that class to. But, I mean, I'm with you, right? You take a look at the national debt and it just keeps rolling up and up and up. I mean, again, I know we showed that U.S. debt clock. When you want to have a heart attack, go to usdebtclock.org and you can see how much we're in debt, and then it breaks it down per citizen. The other thing that only gave me, a more positive feel of it is that there's a lot of other countries that are in the same situation, some better, some worse. I don't think they really care anymore about the national debt, right? It seems like they can print money and create dollars, and can they delete national debt? No, what are all the impacts? Again, there's economists and people that are super smarter than me that can give you their opinion about that, but I mean, you're right, something's gotta be done, right? But I don't know what the answer is, so, but there's a lot of other people that are in that boat, country-wise, I mean.
You get the answer, we'll make you president.
I don't want that job. I want to stay here in Roanoke County. I'm good with it. They don't need to go to Capitol Hill. Yeah, it's really like lose your soul, it seems like. I don't want to go there. Yeah, I mean, if it's an annuity, which kind of sounds like it is, they're going to have a term to when it comes free out of surrender, right? There's 3-year, 5-year, 7-year, 10-year, 15-year annuities out there, right? I mean, there's all sorts of kinds that are, so yeah, well, actually, I couldn't say that. There's that one time we had somebody come in and they were in an annuity from a long time ago, I don't know, it was in the 80s or early 90s. I called the company with them, I'm like, hey, when's this thing come out of surrender? And they said, never. And I'm like, what? Like, that's the first time I heard that. And honestly, it was the first time I ever heard that. This was a contract, I think it's like outlawed now, which it should be. But there was always a penalty no matter what, so. But yes, typically 99% of the time there's a term that you can serve. If it's annuity, like I said, I'm assuming that, I don't know, without looking at it. There is a time where it ends. And again, we use that with a lot of people. I mean, we use a lot of, say, 7-year products on the annuity space. When the 7 years is up, we'll contact you and say, hey, it's out of surrender. Let's go somewhere else for this reason. Is it to your Fidelity account? Is it to another annuity? We just make that decision at that time. So that wraps it up. Hopefully the tax one wasn't too terrible, but I can only make it so exciting, but everybody likes making more money at the end of the day, so I think that's a positive to it.